Most retirees assume Social Security is simply theirs, tax-free, because they already paid into it their whole working life. Up to 85% of it can actually be taxed. The thresholds haven't changed since 1984. Pulling an extra $1,000 from your retirement account doesn't just get taxed once. It can trigger a second, hidden tax at the same time. Planners call this the tax torpedo, because it hits hardest in the middle of retirement income, not at the top. In one real example, an extra $1,000 withdrawal ended up creating $1,850 of taxable income. There's a new deduction this year that many assume fixes this. It doesn't, not in the way most people think. I'm Kevin. This is Prosperity Levels. Today, the formula, why it's called a torpedo, this year's new deduction, and how to manage it. Quick note, not a financial advisor, this is educational. Talk to a professional, especially a retirement-focused tax advisor. Let's start with the formula the IRS actually uses. The IRS doesn't look at your Social Security benefit amount by itself to decide if it's taxable. Instead, it calculates something called provisional income, or combined income. The formula, AGI, plus tax-exempt interest, plus 1/2 of your Social Security benefit. That half of your benefit piece trips people up. Even untouched, half of it still counts. The tax-exempt interest piece is surprising. Municipal bond interest, meant to be tax-free, still gets added back in. This is one of the few places in the tax code where money the IRS otherwise doesn't tax still counts against you. Once calculated, this provisional income figure runs through two threshold levels. Below the first, none is taxable. Between the first and second, up to 50%. Above the second, up to 85%. 85% is a cap, not a flat rate. Even at very high income, 15% always stays tax-free. Let's get specific about the actual numbers for 2026. For single filers, provisional income below $25,000 means zero federal tax. Between $25,000 and $34,000, up to 50% becomes taxable. Above $34,000, up to 85% can be taxed. For married couples filing jointly, the same structure applies at different numbers, $32,000 and $44,000. Below $32,000, zero tax. Between $32,000 to $44,000, up to 50%. Above $44,000, up to 85%. These thresholds are not adjusted for inflation. Frozen since 1984 for the first tier, since 1993 for the 85% tier. Every year, Social Security gets a cost of living adjustment. The thresholds do not. More retirees drift into taxable territory every year, without any new law being passed. A retiree unaffected 10 years ago may be affected today, having done nothing differently except receive their normal raise. Here's the mechanism that gives this its nickname, and why it matters far more than most retirees realize. Inside a specific income zone, extra income can simultaneously pull more of your Social Security into taxability at the same moment. Real example, a single filer with a $30,000 Social Security benefit takes an extra $1,000 from a traditional IRA. That extra $1,000 pulls an additional $850 of previously untaxed Social Security into taxable territory. Add those together, $1,000 plus $850 equals $1,850 of total new taxable income from a single $1,000 withdrawal. At a 12% tax bracket, the real effective rate on that withdrawal isn't 12%. It's approximately 22.2%. In the 22% bracket, the same math produces an effective marginal rate north of 40%. Second example, a single retiree sits at $33,900 in provisional income, just $100 below the $34,000 threshold. Their RMD increases by $200, an ordinary, unavoidable increase. At 22% bracket, this $200 increase raises their tax bill by roughly $81, a 40.5% effective marginal rate. This is the torpedo, a narrow zone where ordinary taxation and rising Social Security taxability compound on the exact same dollar. There's one filing status that makes this dramatically worse, and it catches people who file separately for unrelated reasons. If married, filing separately, and lived with your spouse at any point during the year, your threshold isn't $25,000 or $32,000. It's zero. Up to 85% becomes taxable starting from your very first dollar of provisional income. There's effectively no protected tier at all for this specific filing combination. This is one of the rare situations where filing jointly is almost always better for a retired couple, even when other factors might favor separate filing. If considering filing separately from your spouse for any reason, this specific rule needs to be checked first. This year introduced a genuinely new wrinkle, and it's widely misunderstood by retirees trying to use it to manage this exact problem. Under the One Big Beautiful Bill Act, taxpayers 65 and older get an additional $6,000 deduction, whether they itemize or take the standard deduction. A married couple where both spouses are 65 or older can claim $12,000 combined. Available for tax years 2025 through 2028, a temporary provision, not permanent. It phases out gradually once MAGI crosses roughly $75,000 single, or $150,000 married filing jointly. Here's the part that surprises even experienced retirees: this deduction reduces taxable income. It does not reduce AGI. Since provisional income starts from AGI, this deduction has zero direct effect on how much Social Security becomes taxable. Claiming this deduction does not shrink the percentage of your benefit pulled into taxability, that's locked in by provisional income regardless. What it can do is reduce or eliminate the actual tax owed on whatever portion was already determined taxable. It's a subtle but important distinction. It doesn't change the torpedo mechanism, it can just make the final tax bill smaller, or zero. Let's walk through a complete, real example showing exactly how all of this fits together. Eleanor is 72, single, living in California. Her Social Security benefit, $24,000, reflecting the standard cost of living increase. She also has $10,000 pension income, $3,000 taxable interest, dividends, and $2,000 tax-exempt municipal bond interest. Her total gross income across everything, $39,000. But that's not the number that determines her Social Security taxability. Provisional income, her $13,000 AGI, plus the $2,000 muni interest added back, plus half of her $24,000 benefit, which is $12,000. Total provisional income, $13,000 plus $2,000 plus $12,000, equals $27,000. That lands her between $25,000 and $34,000, the 50% tier. The taxable portion comes out to the lesser of $1,000, or 50% of her total benefit. In her case, $1,000 becomes taxable. Her standard deduction, including the over 65 amount, comes to roughly $17,600. Add the new $6,000 senior deduction, $23,600 total. Her total taxable income before deductions, $13,000 AGI plus $1,000 taxable Social Security, comes to $14,000. Since $14,000 is less than her $23,600 in combined deductions, her final taxable income is zero. This example shows both halves at once. The torpedo determined $1,000 was taxable, and the senior deduction wiped out the tax owed on it. A short but important list, because this determines how much control you actually have over your own provisional income. Counts: traditional IRA, 401k, withdrawals, RMDs, pension income, wages, taxable interest, dividends, capital gains, and tax-exempt muni interest. Does not count: qualified withdrawals from a Roth IRA. This is the single mechanical reason Roth assets are so valuable for retirees worried about Social Security taxation. A retiree funding spending from a Roth instead of traditional keeps provisional income lower, keeping more Social Security untaxed. This connects directly to the backdoor and mega backdoor Roth strategies from a previous video. The benefit compounds decades later. Here's what's actually actionable for anyone approaching or already in retirement. Strategy 1. Convert traditional IRA to Roth before RMDs begin, ideally before claiming Social Security. Optimal window, ages 60 to 72. Every dollar converted now permanently reduces your future RMD balance, lowering provisional income in your 70s and 80s. Strategy 2. Use qualified charitable distributions after 70.5. Money sent directly to charity satisfies RMD without touching AGI. Strategy 3. Draw retirement spending from a mix of account types, prioritizing Roth withdrawals near a provisional income threshold. Strategy 4. Maximize pre-tax retirement contributions before retirement, the same mega reduction principle from the IRMAA video. Strategy 5. Muni bonds don't shield you from this calculation. A muni-heavy portfolio can push a retiree from 50% into the 85% tier. Strategy 6. Consider where you live. 41 states don't tax Social Security at all, a handful still do. Strategy 7. Coordinate your claiming age with your broader tax picture. The claiming decision and tax decision are tangled together. This isn't a claim that Social Security taxation is unfair, or that every retiree should panic. A few honest caveats. Even at 85% inclusion, you're paying tax on a portion at your normal rate, not losing 85% of your check outright. Someone with very high income pays a lower effective rate than someone earning the same amount entirely from wages. 15% always stays untouchable. The Roth conversion strategy has trade-offs. Converting too aggressively can push a higher bracket or trigger the IRMAA cliff from a previous video. State-level Social Security taxation varies and changes over time. Always verify your specific state's current rules. The formula that determines your Social Security taxation hasn't changed in decades, but the tools to manage it have changed dramatically. Most retirees think about how much income comes in. Few think about which bucket it comes from, even though that determines whether the torpedo hits. The new senior deduction is a genuine benefit, but only if you understand what it does and doesn't fix. If this changed how you think about which account to draw from in retirement, hit the like button. Final numbers, 2026 thresholds at $25,000, $34,000 single, $32,000, $44,000 married, frozen since 1984 and 1993. In the torpedo zone, an extra $1,000 withdrawal can create $1,850 of taxable income, a stated 12% bracket becoming an effective 22%, or 22% becoming 40% plus. The 2026 senior deduction, $6,000 single or $12,000 married, reduces taxable income but not provisional income. Roth withdrawals never enter this formula at all, the single most powerful, permanent lever for retirement income planning. Subscribe for more. This channel has covered an entire retirement journey, from the Trump account at birth to the tax torpedo hiding in Social Security itself. This is Kevin. This is Prosperity Levels. I'll see you in the next one.